Hi everyone, so we're going to be looking at provisions, contingent liabilities and contingent assets, how to account for them in line with this standard here. So imagine you have a court case. Your accountant is looking worried. Why is he looking worried? Because the company's probably going to have to pay out some money and there's a potential liability to record, and he's not wrong. So provision is a liability of uncertain timing and amount. We don't know when we're going to have to pay the money, and we don't know how much we're going to have to pay out. We can only estimate its value. So provisions can arise in court cases, damages from court cases, or fines from regulators, for example. They can arise as a result of warranties. So warranty is an obligation to repair an item free of charge within a certain period of time. Mining companies often have provisions for restoring their sites to the original condition, and we call those restoration provisions. Okay, so these are just three examples, but there are multiple. Like insurance companies often have huge provisions because they have to pay money to customers for valid claims. Okay, and calculating provision requires a bit of judgment based on probability and a number of factors. Now, there are three criteria needed to record a provision, and the criteria are strict because in the past people used to record provisions 1 year and then deliberately release the provision over time. So they would do debit provision, credit expense to inflate their profits. Okay, so it's a bit of a way of smoothing out the profits, especially in volatile industries where profits were continuously fluctuating. So the standards were then amended so that there are now three criteria for recognizing a provision. So the first one is that there's a present obligation arising as a result of a past event. So an example of a past event could be entering into a contract before the year end or breaking a regulation during the year. We also have to have probable cash outflow, so this is normally assumed to be above 50%, and costs have to be able to be reliably estimated. If you don't have these any of these three criteria, you don't have a provision, but you might have a contingent liability. So contingent liability is where two of three criteria are met. The first one has to be a present obligation arising as a result of a past event, but either cash outflow is not probable or provision cannot be reliably estimated. Okay? And what's the difference? Well, contingent liability, you don't record on the balance sheet. You instead disclose a note in the financial statement. Okay? So this rule only applies to single entity financial statements. For group, you do record them on the balance sheet, but that's another story. Have to discuss contingent assets. These are potential assets that arise from past events that will be confirmed by future events under the entity's control. So maybe we might get some money from a court case later on in the future, but it's not an actual asset, it's a potential asset, so we don't record it in the balance sheet of single entity FS. But we do disclose the relevant details in the notes of the financial statements if it's material to the users. Okay, so try and remember these 3 points. You might be able to get a few marks, GC marks, as a result. Now, obligations can either be legal, i.e. defined by legislation, or constructive. So constructive obligation arises when there's a business practice or custom that indicates that the company will fulfill an obligation. Maybe how it's behaved in the past, like some mining companies might, not because of contractual reasons, but because they feel, because they're moral, they restore the site to its original condition. So just read through the exam question and see which of these are met. Okay, or warranties might not be specified in the contracts, but the company normally repairs items free of charge within a certain period of time. Okay, so it might not be contractual, might not be specified in the contract. Another area that can lead, an action that can lead to provisions is restructuring a business. So a business can be normally restructured when a company is trying to modify and reshape its operations to reduce debt and increase efficiencies. So reduce its costs, basically. And that often involves laying off a lot of staff. Now, you can only recognize a provision if you have a detailed formal plan for restructuring the business, and a valid expectation has been raised in relation to the expected parties. Okay. Now, for any future operating losses, we don't treat those as a provision, okay, because those are a future event. So you can only have these two criteria. These two criteria have to be met. Another thing that can lead to provisions are onerous contracts. So these are revenue generating contracts where the unavoidable costs associated with the contract are higher than the expected economic benefits. So we're losing money on the contract. We're making a loss on the contract. So the unavoidable costs of the contract are the lower costs that directly relate to fulfilling the contract and the cost required to terminate the contract. Okay, so try and remember this rule and see if you can apply it to the question. And we record the unavoidable costs as a provision. So provision is essentially an estimate. There are different ways you can estimate the provision. So for a single outcome, we can use the best estimate. For example, if there's a 70% chance of £12,000 payout versus 30% chance of £11,000, we pick the £12,000. Now, for multiple outcomes, where you have a mixture of outcomes, like you can have major or minor repairs, which cost different amounts, we use a weighted average, which I'm going to explain in more detail. We can also use post-year-end data to assess the valuation of the provision at the year-end. So, for example, progression of a court case after the year-end, or progression of regulatory proceedings against a company. Okay. So as an auditor, you can't just when you're assessing the valuation of provision, you have to look at post-year-end data, reading through board minutes or reading through legal correspondence in relation to a particular matter. Okay. Where the time value of money is material, we need to measure a provision at its present value. Okay. What this basically means is that if a provision is to be paid out in 30 years' time, say if you have to pay out a provision of 30 million in 10 years' time, at present day, it's not good. The provision won't have a value of 30 million. It will have a value of less than 30 million. Okay, because paying out 30 million in 10 years' time is much better than paying out 30 million immediately. Okay, we'll explain that in a bit more detail. Now, for multiple outcomes, I mentioned that you can use a weighted average, and this often occurs with warranty provisions in the exam. So imagine you have 100% of goods require major repairs. If 100% of goods required major repairs, this would cost 13,000, and for minor repairs, if 100% of goods required that would cost 6,000. Now, at the year end, we expect 10% of goods to require major, 30% of goods to require minor. How do we record the provision? Well, using maths, we can do 10% of the 13,000 plus 30% times the 6,000. Okay, and that would give us a total cost of 3.1 million. So just to reiterate, we've done 10% of 13k plus 30% times 6k, and that gives us 3.1k. Right? So how do we record the provision? Well, we do debit cost of sales 3.1k and credit provision 3.1k. Okay, so it's hitting our profit and loss statement. Now, we have to sometimes factor in the time value of money, as I said, if it's material. So consider this situation. I finished building a nuclear power plant, which I expect to decommission on 1st of Jan 32 for a cost of £30 million. And the recognition criteria have been met on 1st of January 22. What do I do? Well, firstly, we need to use a discount factor for any time value of money. So just to summarize, the 30 million has been paid out here, but we need to record a provision at 1st of Jan 22 because the criteria have been met. And we factor in a discount factor. Okay, so this value, the provision is going to be at a value lower than the 30 million. So how do we do it? Well, we divide by 1 plus the discount factor to the power of number of years. Okay, so discount factor has a value of 5%, 1 plus that is 1.05, and we're doing that to the power of 10. Because the difference between this date and this date is 10 years. and that gives us a value of 18.4 million, right? So it's much lower than the 30 million, probably materially different, isn't it? Now, the double entries are debit for decommissioning provision, okay, or we debit PPE 18.4 million and credit provision 18.4 million, okay? So anything to do with dismantling an asset, decommissioning an asset, we capitalize, okay? So we put it to PPE, and then we depreciate the PPE over the useful life. So we depreciate the PPE over the 10-year period. Now, 18.4 million was the 1st of Jan 22, but our year end is 31st of December 22. So what do we do? Well, the discount factor is like interest. So what we need to do is we need to calculate the interest between this date and this date. And to calculate that, we do 18.4% times 5%. So the 5% was per annum, okay? I'm just going to put per annum just to make that clearer. And I'm just going to where is my, okay, arrow options, automatic. Okay, fine. So the finance cost is 18.4 million multiplied by 5%, and that gives us 0.9 million. So what is our value? What are the double entries for that? Well, we're doing debit finance cost of 0.9 million and credit provision 0.9 million. So our provision is increasing in value to 19.3 million. So over time, it's increasing to the point where it's going to reach the 30 million. Okay. So basically, we recognize the finance cost and the provision increases in value. Okay, and in this step here, you might have to consider, is the period 1 year or is the period half a year? Well, in the case of half a year, we would obviously times by a half. So just to summarize the key points, so a provision is a liability of uncertain timing and amount. We don't know how much we're going to pay or when we're going to pay the money. There are 3 criteria for recognition: probable outflow, present obligation, reliably estimated. Okay, probable outflow is defined as more than 50%, 50% or more. Provision obligation can either be legal or constructive. So constructive is based on past behaviour, legal, contractual, or due to legislation. We consider for most likely outcome. We can consider the most likely outcome for a single obligation as the best estimate, or we can use the weighted average for multiple outcomes. So the most common exam question is a warranty provision. We do need to consider time value of money if material. So please state the material fact in the exam. Contingent liability arises where only 2 of 3 criteria are met. So it has to be a present obligation as a result of a past event, but there's either no probable cash outflow or cost cannot be reliably estimated. Okay, but we do need to disclose it in the financial statements. We do need to disclose it in a note, but not in the balance sheet. You can have a provision where for an onerous contract, and this is where unavoidable costs are greater than economic benefit. Restructuring only leads to provisions if 2 criteria are met. You have to have a detailed formal plan, and relevant parties have to be communicated with. We do not make a provision for future operating losses. Okay, so they'll try and trick you maybe in the exam. Just be careful with that. So normally for a provision we do debit expense credit provision. So for a warranty provision it will be debit cost of sales because it's to do with inventory. But for PPE, where we're dismantling PPE or decommissioning it, we do debit PPE and credit provision. Okay, and then we depreciate the PPE over its useful life. Okay, and then that's it really. It's just trying to learn these points and be able to apply them in exam situation. Provisions are an area where you can get get quite a few marks in. Okay, so I hope that was useful everybody, and good luck in your exams. Cheers, bye.